In this part, I'm just introducing the general criteria for expense recognition. Expense recognition basically is to match the revenue. So that's why we generally call the expense recognition as matching principle. Why matching principle is so important? Because if we want to learn a firm's performance only its output and input are matched, then this ratio could be considered as good indicator. So output, if it is revenue, input must be expenses. So only they are matched. So the difference, more specifically earnings, will be more useful. So when we recognize revenue, we should also recognize the matched expenses. Some expenses have direct relation with the revenue. Some do not. The costs that have direct relation with the revenue, we call it product cost. For that do not have direct relation, we call them period cost. More specifically, in the income statement, cost of goods sold, or COGS, or cost of sales, is considered as product cost, and others are recorded as period cost. The example is SG&A costs or expenses. And both costs embody the matching principle. First, product cost. So the product cost generally includes direct labor, and manufacturing overhead. And direct costs can be traceable to the sales, but overhead cost, we can use some methods to make it traceable. So that's why revenue and the cost of goods sold, they have very stable and direct relation. For example, when Apple produces an iPhone, it always needs a screen, a CPU, memory, battery, and all other items. We can easily calculate the cost of these components and associated labors. So on average, to produce an iPhone, the incurred cost is a certain percentage of the sales revenue. For example, 25%. So this is also true when you analyze a lot of firms. By learning the common size analysis, you will have the percentage of cost of goods sold over revenue. And in the short term, or in a few years, the relation between the cost of goods sold and revenue is very stable, unless the firm change its product mix or improve their production efficiency. And the period cost cannot match the revenue as the way product cost does. It embodies matching principle by matching by time. So during a period of time, maybe this is 1 year, during this year, the firm sells a number of products. To sell these products, the firm must incur costs such as manager's salary, bad debt expense, R&D, maintenance, advertising, and marketing. For a certain amount of products, the firm also incurred a certain amount of period cost, and the cost is matched the sales of product during this year. And also in the notes, you should be able to find expense recognition policy for all kinds of expenses. Please read that. That will be very helpful. So this is 10K of Walmart. Check the accounting policy. You can always find inventory is what assumption they use to calculate the cost of goods sold. And this is property and equipment is how they estimate their depreciation expense. This is about income tax, revenue recognition, and cost of sales, advertising costs, operating, selling, general, and administrative expenses policy. Okay, please read your firm's note.